3rd, 2024, and I am back with the first edition of the Wednesday live show for 2024, and it should be quite the interesting year. A lot of people complained about 2023 for whatever reason. I guess a lot of weird stuff went on, but the market itself, aside from everything else, the market itself did really good. So I got a graphic over here on my other screen that tells me that the SPY was up 24%. The Qs, the Nasdaq 100, was up 53.8%, almost 54%. Incredible. VTI, the broadest market index, I guess that's the Vanguard whole market index, was up 24%, a little over 24%. So, what a spectacular year following last year, which wasn't so spectacular. So, it's kind of interesting, but it is what it is. And so, um, yeah, I've seen a lot of end of year recaps, that type of thing, talk. The most interesting thing I think I saw, let me get rid of this, go right to the S&P chart. One of the more interesting things that I think I saw recently was the actual earnings of the S&P. And the funny thing is that the earnings for the S&P are actually have been declining for the past couple of years. And so, this big rally and everything that we've seen has been a little weird because obviously, the Magnificent Seven stocks have been bid up, and there's been a lot of what I would say a narrow market is what it is. And so kind of a narrow market, and for the market to have surged, and this is the most interesting thing to me, is let's go back. I mean, since this is the beginning of the year, we might as well talk about how the year ended. I mean, we're on the second trading day of 2024 right here. So, anyway, as of like the beginning of November, like back here around the lows, the S&P was up 7% on the year. So really from November to the end of the year, that's where the bulk of last year's return came from. Just all of a sudden, things were not looking so hot here, right? Because I mean, you went all of August and all of September and all of October basically with the market pulling back and in a downtrend and looking a little bit rough right here, right? Broke below the 200-day moving average there. And so, I mean, the market was not looking so hot. And then of course, there was a little rebound that turned into like, a short covering melt up type of situation, and that just kept going. And so November and December were basically, 2 months out of the year, the market just decided to melt up. And a lot of it, for the past couple of years, everything's been sort of based on what the Fed is going to do with interest rates. And of course, they did a 180, right? Um, they had maintained, throughout most of the year that it was going to be higher for longer, and of course, interest rates. And then all of a sudden, the very last Fed meeting, they entertained the idea of lowering interest rates because the rate of inflation has been declining. So it seems like it's very much a Fed-driven, interest rate-driven sort of market, and I mean, it was a wild year, right? It was kind of a normal year up until the very end there. Like this rally in the middle of November and that extra little rally there, based on the idea that the Fed's going to lower interest rates. And of course, the market is pricing in more rate cuts than the Fed is and all this kind of stuff. So it's going to be interesting. I believe it might be today that the Fed minutes are going to be released at 2 o'clock, and so that may add a little excitement to it. quite frankly, the past couple of weeks, everyone's been in holiday mode, and so it kind of feels like the market's still in holiday mode today. It honestly does. So it honestly feels like there's actually quite a bit of economic data coming out this week, I believe, but it seems like the market's just kind of fluttering around in holiday mode, and I guess things will really start to gear up next week. This is a 4-day week at the beginning of the year, and so we'll have to see how it plays out. What I do notice though is I looked through a lot of charts over the weekend and last night. There's a lot of sort of pivot highs all over the charts. Tons of pivot highs all over the charts, and if you zoom back, and this is pretty interesting too. I should probably pull up. Well, I will pull up a weekly chart, but basically you've had the beginning of 2022. The beginning of 2022 is when the bear market started, right? And so we rallied basically all the way back up to that. Let's see, there we go. I got a horizontal line up here. This high right here, what was that high? 48.1862. And so this horizontal line here, let's see, 1860. Excuse me. Ugh. This horizontal line, it's a little difficult. Yeah, it's close enough. That's close enough. Oh jeez. And so there you go, just shy of the high, and it's kind of double toppy looking, right? It looks a little bit weird there. Let's see, maybe this one looks a little bit better. Um, yeah, it's the same sort of thing. You got the cup and handle. Um, so it's going to be interesting to see what exactly happens here. Um, Here's something to keep in mind. Let me go back to that prior chart there. Something to keep in mind is, I'll pull this down, based on the inflation, based on just the CPI over these 2 years, 2022 and 2023, the market has to hit 53. The S&P actually has to hit right about 5,300, just under 5,300, in order to make like an inflation adjusted new high, which is kind of interesting. It's something that I keep in mind because um, because that's been the whole point of contention. Like that's what everything's been based on, is the idea that the Fed raised rates because inflation was out of control, but now it's coming down, and so they may lower rates. But um, yeah, so if you had $4,818 back here, um, in order to buy the same amount of goods and or services now, you got to have $5,300 instead of 48. So that's 500, extra bucks. So that's just something to keep in mind. It's kind of interesting actually to do an inflation adjusted. A couple other things to look at. IWM. IWM's got like sort of this spike high, and look at it falling here. It's interesting when the calendar rolls over how sometimes the nature of the market sort of changes. So look at the beginning of 2022. It was the same sort of thing. Beginning of 2022, everything was sort of going along fine. Now, the Russell had just been going sideways, but it hit this high, like it broke out to a new high, and then right at the beginning of 2022, it basically tanked, and then that's where the whole bear market came from of 2022. So, and then for 2023, the Russell it did nothing all year. It was right back at the bear market lows, and then, it put on like a record-breaking rally during that same period of time from November to the end of the year. So, but the thing about the Russell here is that we've talked about this. I got it in my list here. Let me pull up my marked up chart, because the thing about the Russell is that it has it has these trends, sort of like once it reverses direction and starts moving in the opposite direction, it tends to get considerable follow through in the opposite direction. But as we speak right here, the most interesting thing about this is how it broke out of the channel, and then it's coming right back into it in just a few days, right? So I mean, look at how it's given up like 2 weeks worth of, yeah, 2 or 3 weeks worth of gains all the way back down to here in just a couple of days. Actually, this looks like the last trading day of last year. So what this reminds me of, what this little sort of spike high reminds me of, is this false breakout back here, right? So it was just kind of, is a weird sort of animal. It's in its own world. There'll be days where the Russell stocks are higher and the rest of the market goes down, or vice versa. It doesn't trade necessarily on a day-to-day basis in tandem with the S&P or the Nasdaq. So it's in its own world. But in theory, it should be finding some support here. But you can see that gap. There's a gap there too. So it's kind of at a critical juncture. I mean, it's impossible to say what's going to happen. It could consolidate here, because as we speak, I mean, it's down, but it's sitting at like a level of pretty significant support here. And so it could clang around in this area, just consolidate, or if it follows the typical pattern we've seen here, then it was kind of a false breakout, and we would expect it to start pulling back inside this channel. So tons and tons of stocks. I saw yesterday, this is kind of interesting. Apple got whacked yesterday. I forget, I saw a stat that said, how many billions, it was like $128 billion or $128 billion of market cap on that little sort of, dip right there, which is kind of interesting. But yeah, Apple's got this sort of weird pattern too, where and 2023 was the year of these mega cap stocks. Just at the beginning of the year, they sort of took off, and just incredibly had that sort of, pattern there that was just persistent uptrend. One of the more persistent uptrends. Microsoft had the same thing too. Microsoft had, in 2023, had there's a couple of bigger dips here, but extremely persistent uptrend, a couple of dips, and then ran to new highs. And so let's see what else. Amazon, interestingly enough, you go way back here. Amazon, I guess is considered one of the Magnificent Seven, but it hasn't hit a high. It's still back over here. It's got a lot of work to do, and this trades like sort of in a really wacky sort of pattern. I don't know what to make of that. I guess I should be looking at a weekly chart. I don't know what to make of this kind of pattern, but whoops. I wanted to look at the other ones. Google. Yeah, same with Google. So if you don't look back at the longer term charts, then you don't really get the kind of perspective like a lot of people would probably assume, if they just look at, a 1-year chart or something, assume that, all these Magnificent Seven stocks were at new highs. And it's kind of like if you go back to the really longer term charts, there's a lot of stocks. Well, not a lot, but some stocks have never exceeded the high from the dot-com bubble back in 2000. I don't know that I can go back far enough to see that, but just for the fun of it. Oh yeah, I guess I can on a monthly chart. Huh. Well, I'm wrong here because well, I thought it was Intel. Let's see, GE. Yeah, there's just one off the top of my head. Like GE, right? Look at the 2000 peak back over here. It was $200. I believe this is I think this is split, but anyways, look at that. 23 years later, almost 24 years later, almost. Um, they're yeah, GE's not back there, and so there's other examples of that. But anyway, this time of year, well, actually over the weekend, typically the best time to look at the longer term charts. So let's see here. So we're in sort of dip mode here, pullback mode, whatever you want to call it, because we've got these spike highs, reversal highs, little sort of peaks or whatever. It's kind of like a mountain range is how I look at these charts. And so, here's you're climbing up the mountain, and then there's the summit, and then it starts, going down. And then, like I said, it was either last week or I think I took last week off. It was the week between Christmas and New Year's. And so, anyway, but the last time I did a show, I talked about the tax loss selling and how no one wants to sell their winners, and have to pay tax on it in the next few months. And so it seems like everybody held off and started selling at the beginning of the year. And clearly, the markets themselves were extended and overbought. Back to the S&P. Let's see. I have where is my chart that has oh, here it is. This is the one that has the markups on it. Yeah, what I wanted to look at was, because remember we talked about the RSI here. And so, it wasn't a huge stretch. It honestly wasn't a huge stretch. When that RSI got up, to about 80 or over 80, it wasn't a huge stretch that the market was due for a pullback. That's just sort of the way it works. In the old days, the market can stay overbought for a really long time, right? It can kind of meander around, and the RSI can, like a really peaks of this RSI can get worked off pretty easily. So, like back over here in June, you can see where the end of the RSI got up into the 70s, and then there was a little bit of a dip, and it got worked off pretty quick, and the market continued higher. And over here's a pretty good example too. Like in July, the RSI got into into overbought territory, and then the market kind of continued to go higher. And then, interestingly enough, there was this day right here. This day, which on the chart, because of the scale of the chart, it doesn't look like much, but at the time this was like a huge, bearish engulfing outside reversal bar type of thing, and it just basically signaled that the market was due for a pullback. And I remember it being one of the weirdest ones I've ever seen, because the next few days, like the next day, the market gapped up, and then you had a few inside days, and then you began the long sort of pullback. So from August to November. But anyway, looking a little toppy here, and so it's going to be interesting to see, how this dip that we're in here manifests. But you can see, look at how the RSI is already way off of how overbought it was over here. So, and this was kind of this day right here was, so that was 1220. That was kind of one of those outside reversal type of, days that the day prior to that is when the RSI peaked, right? The RSI peaked, you can see down there, and then the following day it was closed below 70 because of that, you know, big red bar down there. And then it came back and made a new high into the end of the year. Um, anyway, it's interesting to see how the RSI has worked off being overbought so quickly. I mean, it hasn't really been that long. So let me pull that back down here. So, anyways, what to expect this year? Hey, it's hard to tell, quite honestly. It's an election year, which always makes things weird, and there's a lot of saber rattling around the world, a lot of unstable situations. It's really strange how that end of the year rally manifested, and I think it's just crazy, to be honest with you. And quite honestly, I'm not sure what to make of it. To me, it sort of reeks of sort of kind of a humongous short squeeze, right? Because everybody was pretty darn bearish down here, below 4250, in this area, 4200, and everything down there. The sentiment was extremely negative, and a lot of people were looking for the bottom to sort of drop out. And of course, all year long, there was a lot of talk about a recession, that type of thing. So, I, you know, it's hard to say what 2024 is going to bring. But the thing that really sort of bugs me is, like I said, that table that I saw of the actual earnings of the S&P. And so, I mean, you've had a couple years of declining earnings. So this is all like sort of multiple expansion. But like I always say, there's so many pieces of the puzzle that and one thing that last year kind of proved, or I should say the end of the year, I guess, everybody takes the year in aggregate because things are measured on certain scales. But when I look at this chart, it seemed like a fairly normal year in the market all the way up until, the last couple of months there with the proverbial melt up. I would say that was a melt up. And so, a couple things come to mind. One is that, Wall Street needed a good year. They wanted their bonuses, that type of thing. It was almost, potentially like an orchestrated short squeeze, because the macro fundamentals don't necessarily, or, if you just look at it in aggregate, to me, the macro fundamentals and the state of, the state of the world don't support, the kind of run that we saw in the 24% up year. But hey, it's an election year, and so, I mean, we're going into an election year, and so um, it's in a lot of people's best interest, should say, to have good markets and a good economy and all that kind of stuff. And so, I mean, people are coming out and accusing Powell of being political, which is kind of interesting. That's a whole nother conversation that I don't know that much about. But I mean, that's as that last Fed meeting where he basically, sort of pivoted with his words as far as, now they're talking about lowering rates or whatever. And to their credit, the rate of inflation, I believe, if and quite frankly, you got to take their numbers with a grain of salt. So the way that they calculate inflation is has been changed over the years, and it's very discombobulated and kind of doesn't make sense. So I don't um, I don't know what to make of all that. But the thing of it is that I know that everything is a lot more. The general, I've been telling, I talk to people on the street, my friends and that don't really follow the markets and economy like I do. I tell them, hey, the general price level since pre-pandemic, a few short years ago, if you took it in aggregate, everything's probably about 25% to 30% more expensive. I mean, in aggregate than it was. And so, when nobody talks about, and they're starting to talk about this more. Interest. I've been talking about this for ages, is that, even if the inflation rate comes back to 2%, or even if it was zero, um, everything's still going to cost everything's still going to be way, way more expensive than it used to be. And so, they let the genie out of the bottle, so to speak. I guess that's one of over the years, they talk about the letting the inflation genie out of the bottle. It's hard to put it back in. But the thing of it is the damage has already been done, right? Everything's way more expensive than it was just a few short years ago. And so, um, even if they manage to get the inflation rate back to zero, which is not going to happen because I mean they're not, they're shooting for a 2% core PCE or whatever it is, and the one thing they've had working in their favor as far as inflation coming down is the price of oil, which is a whole nother conversation that I'm not going to get into here, but um, it's going to be interesting to see, if this turns into some sort of a double top, right? And it could. Right now, we're just barely, barely off the highs. So, I mean, you get a little bit of a dip and then another rally to take new all-time highs. But I guess the big takeaway here, I'm going to wrap this up. The big takeaway here is go to the inflation calculator, put in 4818 in January of 2022, and I haven't done this since I don't know if they've updated it, but I haven't done this a couple of months. But anyways, like right about here, S&P needs to be at, like, this S&P would need to be here to hit an inflation adjusted new all-time high. So when they talk about new all-time highs, a long time ago, I looked at, I think it was like Venezuela stock market or something, and it was up huge, right? So, I mean, the idea is that if your inflation rate is, 1,000% and the market goes up, 600%, then you lost money, you lost purchasing power. And so that's what it's all about. People are starting to wake up to the idea that it's all about purchasing power with anything. So, and so I kind of keep that in mind. So this is, I mean, it could make a nominal new high, but it's a long ways away from. And so that's the idea. I mean, stocks are supposed to keep up. They're like supposed to be the one thing that keeps up with inflation, right? And preserves purchasing power. And so as of right now, over the past couple of years, a lot of purchasing power has been lost, and I haven't done the calculation, but the thing of it is that so the market went up 24% last year, right? But it needed, in order to actually, and of course nobody just took all their money and bought right there at the peak, and so, you know, generally speaking, I mean, people that, in 401ks over this 2-year period here kept contributing as the market pulled back, and so that was the best place to be, because then when it gets back here, they got a bunch of shares that they bought low. So index investing, and you see a lot of this around the end of years and beginning of the years, that for the average American worker or whatever, long-term index investing in a 401k with the company match is definitely the way to go. So, but as far as us, swing traders, I should say, then the idea is that there's a whole different approach to the market besides that. And so anyway, I'm going to go ahead and wrap this up, and I will see you back here next week, same time, same place, and we'll see where we are at that point.